Broadcom Inc. ticker symbol AVGO is currently trading at $157.70 a share. They've had a little bit of a boost today based off their 10 billion stock buyback. This was announced today. They announced a 10 billion share repurchase program, which obviously reflects the board's confidence in the company's financial strength and future prospects. As we can see here, the company is expected to repurchase common stock throughout the year as CEO showed assurance in the semiconductor company and its AI related investments. Obviously, this is a good telltale sign for the company's prospects, and this is why they're buying back their shares. Then we're going to look at my automated stock valuation spreadsheet to see if Broadcom is a buy or sell using the discounted free cash flow model, comparable company model, and Ben Graham formula for intrinsic value. Just quickly talking about the stock, if we go over the last 5 years, obviously beating the market at 513%, although down 35% from its all-time highs, 16% up over the last year, and year to date it is down 32%. So is this the right time to buy? So let's go to my sheet here and we'll put in the ticker AVGO, and this will load up all the latest company financial data so we can have a deeper dive. If you're interested, check out my Patreon, it's the $4 tier. But Broadcom Inc. $156 a share, market cap of $733 billion. PE ratio looks a little high, 75, which is a lot higher than the market average, which has actually dropped recently to 24.47. Earnings per share $2.07, and a beta, interestingly, of 0.85, meaning it is less volatile than the market. And analysts say to buy at $246 a share. Now, this actually does pay a dividend, 1.16%, which means you get paid $2.51. Is it a safe dividend? Well, in terms of the net income, it's more than 100%, 117%. It's a 12 billion dividend. And the payout ratio is 57% of the free cash flow. So we'll have a look at revenues here. Oh, and if you want to get paid the dividend, buy before June 20th. Revenue is at all-time highs. Yes, it is. 54.53 billion. And you can see here it has increased over year over year. Are they able to generate more net income? Not so much, but 10 billion. Increased to 20 in 2024, but not down from its all-time highs, which were in 23, 14 billion. Free cash flow, increasing. Now, if we look at the operating income versus free cash flow, that's good as well. Very low capex, and operating cash flow is increasing. That's outstanding. There's been some splits in here, but you can see that they were previously pretty consistent. They did do a split. I believe it was a 10-to-1 split. Well, I suppose from these numbers you can see here there's a 10-to-1 split, but now they're going to be doing a buyback. So let's have a look at the discounted free cash flow model. This is the way of valuing stocks. Looking at their competitors, just saying random words there. That's the discount. Looking at the future free cash flows and discounting them to today's value. So currently it's giving us a value of, let me just see, 189. Let's see if we agree with these. In terms of revenue, we're expecting 68 and 67 billion. Analysts are expecting 62, 72. So actually, we're a little bit underestimate. Let's just bring this up a little bit. We'll go 70, $200 a share. Net income margins, see. Let's go 20%. And then net income to free cash flow, although it is pretty consistent. So it does look about fairly valued on the discount free cash flow model. So quite interesting to see. Dividend discount model. Let's see what we are saying now. Now we've got some splits here. This is why it's not taking account of this. But they were previously growing their dividend at about 12%. So if we would increase that and do that, yeah, see 12%. If they increase it at about 12.5%, it would be fairly valued. We can see historically they have been doing that. So dividend discount model says it's about fairly valued. Ben Graham formula for intrinsic value. Looking at this initially, it looks like it's not going to like the stock. Unless they have massive growth, 18.9%, so that is pretty high. But as we can see here, not a buy, $47 a share. Reason for this is the earnings per share is quite low relatively, and yeah, obviously with this AAA bond yield being as high as it is, 5.3%, it is not a buy. But the dividend discount model and discounted free cash flow model do put it pretty fairly valued, which is interesting to see. So finally, let's have a look at the comparable company model. This is a way of valuing stocks looking at their competitors. What we'll do here is we will go with a few that shout at me off the bat. QCOM, this is a wireless technology and semiconductor products. That is Qualcomm. AMD, computer processors and related technologies, things like that. And we'll do two. We'll do Intel and then we'll do NVIDIA just to compare it. So what this will do is we'll look at certain metrics here: revenue growth rates, EBITDA, net income, profit margins, price of sales, price to book, PEG, Peter Lynch's price to earnings growth, and then EV to revenue, EV to EBITDA, PE, and forward P, which go into the model. Although I have just realized that Intel are not profitable, I don't think. So we probably can't do it with Intel. We'll just let this load here. Obviously taking a while. I've requested a lot of data. Might have to redo it here. Just change this to NVIDIA for now. And actually what I'll do, there you go, there's NVIDIA loading slowly but surely. And now we'll go to Intel again, actually. Live software demos every time, you know, it is going to be slow. Yeah, Intel are not profitable, so it's not going to be good. Fine, okay, in that case, we'll do TXN, which is Texas Instruments. And hopefully this all loads here. I don't know why AMD is being a bit slow. Let's just do QCOM to load the data. And then we will switch it back to AMD. Although maybe there's a problem with just AMD. Oh no, there you go, it's just being slow. Okay, fine. So enterprise value, Broadcom is the largest by quite a bit out of these companies. Revenue, highest revenues. Revenue growth rate, second highest, only AMD is higher. EBITDA highest, second most profitable. Qualcomm is second highest. Oh, sorry, yeah, second highest, but still pretty hefty margins, 90%. Price to sales, all high. Broadcom the highest. Price to book, highest. PEG, Peter Lynch's price to earnings growth. Ideally, you want this under 1. It is 0.39, so that is a good indicator. EV to revenue, the highest. EV to EBITDA, highest. PE, second highest. Forward P, second lowest. Puts it at $100 a share, so that's quite interesting here. Now, if we were to compare against QCOM and AMD, it would be put at $102 a share. And if we were to compare against NVIDIA, obviously this will bring everything probably up, but still 110. So it does not look fairly valued compared to its competitors, despite the dividend discount model and the discount free cash flow model saying it's about fairly valued. So yeah, maybe wait for these buybacks, but yeah, according to the models, it is about fairly valued. So yeah, quite interesting. Right, guys, thanks for watching. Please give a like on the video if you enjoyed. Subscribe if you're not already. Check out my Patreon's the $4 tier for the sheet. That means you can do your own stock reviews on any stock that you want. And you don't have to wait for me to do a video. Right, guys, I will catch you all next time. Goodbye.